This is the current Federal Tax Developments podcast for the week of February the 24th, 2025. Current Federal Tax Developments are brought to you by your state society of CPAs. I'm Ed Zollers, and coming to you this week again from Phoenix here as we get into our somewhat winter-spring transition mode here as we're going at this point. This week, we got a few developments taking place. We're going to take a look at some of them here. First thing we're going to do is look at the Second Circuit Court of Appeals case that looked at Section 179D deductions and whether an accounting method change can be used by a taxpayer to catch up if they had previously not taken a Section 179D deduction. We'll talk about why the court found that the answer was no. We'll also talk about IRS released some guidance on web-based Affordable Care Act notice postings for 1095Bs and Cs. Talk a little bit about how that one goes. We also have a court case that takes a look at, did a taxpayer rely on her CPA to provide her with advice about the necessity of filing a trust income tax return or not? And that's going to be a question the court looks at here, looking at whether or not, in fact, she should have a right to raise the question of whether she reasonably relied on a CPA's advice. And we'll talk about why it's a question, what the issue is here, and the unique reason why, even though the IRS tried the argument, the BOI case decision that you can't rely on an agent to file a return for the taxpayer doesn't help them here. It doesn't help the IRS here, helps actually the taxpayer doesn't have that problem, or at least has the right to argue she didn't have that problem. And finally, we've had a number of developments with the beneficial ownership information reporting requirements. We're going to talk about a bunch of them this week. The removal of the final injunction against enforcement of the act. FinCEN's announcement of, hey, we're doing this now. And, the deadline that's coming up if there's no change underlying. And a new congressional attempt to do what they almost did in December with the continuing resolution package. And that would be to push the first due date back for those that were filed in 2024, push that back to, or that were in existence, I say, in 2024, and it had to file by January 1st of 25, push that date back to January 1st of 26. Now, before anybody goes off the deep end here, I'm going to be very clear. This has not yet passed the Senate, not yet been signed by the president, and it's been sitting in the Senate since February the 11th. So, we're not sure if they're going to get to it in time where it will matter. So just be aware of that with what's going on now. But we'll talk a little bit about all the options. There are things up in the air, so it's really, really important right now to keep in mind what the rules are if nothing changes and what some potential changes may be. But we have a deadline approaching fast of March 21st that you really don't want to sit back and wait too long to see what happens. To make sure you have time to act if you need to act. So let's talk first about the case of Cannon Corporation versus Commissioner of Internal Revenue. This is case number 23-7693. It came out of the Second Circuit Court of Appeals, and this case deals with issues related to Section 179D deductions for taxpayers who essentially are, in this case, if you design the building, you can basically, a customer can assign the deduction back to the designer. That's what was happening here. We'll take a look at that. The case came down on February the 18th. So basically, let's talk about the real background of this case. Now, this is Cannon. They were a designer of energy-efficient buildings. They had claimed a 179D deduction for 2007-2010 on their 2011 return. They had not claimed the deduction on those returns. Now, while they did go back and amend 2006, while the statute was open, to basically make the election on a 2006 return, they decided, having read an IRS revenue procedure that came out in 2011, that they instead could use an accounting method change. So instead of having to amend 2007, basically very quickly, and then 2008, 9, and 10, they rather could just do an accounting method change on the return they were working on here in 2011, pick up the entire deduction on that return. That's their theory of how they're going to do it. Now, the IRS denied the claim based on Revenue Procedure 2012-39. That revenue procedure came out just before Canon finished their 2011 return. And that revenue procedure made it very clear that designers could not use the automatic change in accounting method provisions to claim a Section 179D deduction. So that came out just before. So the argument here is kind of, in essence, is 179D, are those deductions effectively, can you make it as an accounting method change if you're the designer that's assigned the deduction from your customer? And, the IRS says no. And the taxpayer said, no, but you had this prior ruling out here, that basically said we could do 179D changes. So we'll talk about where that goes. Now, the taxpayer argued, they said Revenue Procedure 2011-14 indicated that you could use this to report the deductions, a change in accounting method in 179D, and pick up your adjustment under 41A as an adjustment. Remember, if it is an accounting method change and it's an automatic one, and the argument here is that 2011-14 made it into that, is you can file the 3150, basically. You can file the 3115, Form 3115, with that return, and then you have a one big catch-up deduction for the amount you had not deducted previously, or you have a over 4 years spread of income if you have to recognize more income based on, how you reported versus how you now want to be reporting or you're asking to report. And they were saying, well, it's covered by that. We should be able to do that. That gets rid of the whole statute of limitations problem, gets rid of any need to amend prior returns, essentially. And in fact, you can't amend prior returns if it is an accounting method change. A method change requires, basically is something that has to go through the permission sequence. So you have to go down this path. Now, they were arguing there are some cases where the service indicates you could elect between the two in some special situations. But in any event, the taxpayer said, look, based on 2011-14, we prepared an accounting method change. Now, we understand you did put out a revenue procedure, basically a notice later, that said, hey, wait, you can't do that. But we think we should be able to rely on that particular issue, arguing that, the IRS had misrepresented the ability to claim 179D deductions as an accounting method change on that prior notice. The taxpayer had relied upon that, had the return ready and prepared it, and probably was close to or had missed the deadline to amend 2007 because of their reliance on the accounting method change option. And they should be able, therefore, to rely upon it. The IRS can't change the rules that late. And finally, they said, and similarly, they argued for equitable recoupment and a duty of consistency argument, that they said the IRS had inconsistent treatments and that they really shouldn't be. The IRS had pulled the rug out from under them, telling them that the 2007, especially return, could be handled as a accounting method change without having to amend 2007. And then after the statute on 7 had closed, they then changed the rule. And they took away that option, and, they were damaged by that. Now, they also did the other years. So basically, they, at this point, almost certainly have damage for those other years if they didn't at least get protective claims in place by the time the IRS disallowed this. And we have to go back to see how all this worked. Okay, so the IRS is arguing, this is their argument here. Now, the IRS is obviously arguing no, not an accounting method change. The key argument we're going to face here is it truly a change? An accounting method change generally requires not a change in the amount you're going to deduct ever over your lifetime of the company, or the amount of income you're going to pick up, but a change only in when you pick that deduction up or when you pick that income up. And the IRS argument is that when you assign the deduction under 179D, that is it's not a timing change. If the election is never made, this company or Canon would never have received a deduction for the 179D amounts they got to deduct. Right? That is a permanent change. Right? It's one of those things that just, it's not timing. It's just you get it or you don't, depending on whether this election is made. And whether the customer agrees to assign it to you and you therefore then elect to claim the deduction. They're saying that's not an accounting method change. That's an error, right? Canon failed to make the election, even though they had the, permission from the customer. That's an error that they didn't fix that. Not our problem. Okay, how'd the court look at this? Well, they started with the question, which is the first one. If this is an accounting method change, if this is a proper accounting method change, then the IRS would be in error, right? Essentially, because they did say 179D changes could be made by the accounting method change. Now, IRS argument is, well, that only meant the company, basically the company that took it, there's certain options, if the customer did it. But the assignment to the designer was not covered by that. And they claim they just clarified that later. The tax court took a look at, or I should say in this case, the district court took a look at basically took a look at 481D, which is the section involved, and the Treasury regulations, I should say Second Circuit, under this and said, dang, this is a one-time deduction that permanently reduces taxable income. It's not a timing issue. Because it's not a timing issue, it's not an accounting method. Because it's not an accounting method, 481D and the regulations under accounting method changes is not the appropriate mechanism. The appropriate mechanism would be to have amended the returns in question to correct the error, rather than make an accounting method change. Remember, the key issue here, if it's timing only, if it's a timing issue, it's a method. But in this case, they would never get, it's not as if they don't get this timing change, they would eventually get the deduction later. No, they never get the deduction. So it's not a timing issue. Now, Cannon argued that, no, wait, the way the code's written and what the code says about, accounting method changes in that background, they said that, the designer, essentially is treated, basically under 179D, it said designer shall be treated as a taxpayer for purposes of this section, and they said that should interpret us to treat the two, they and their customer, as one taxpayer. And there is the question of who gets to claim this deduction, and that would just be a timing issue. Either the customer got it or they got it. The simple matter of timing. The court didn't buy that theory. The court said no, that the single taxpayer argument was rejected. They said essentially, and they took the position that this is a plain meaning, right? And that's the meaning of the accounting method change, that the plain meaning of the statute controls interpretation, and a judicial review must end at the statute's unambiguous terms. Treated as was an analogy, not a true combination of the two taxpayers. So because of that, no. Now we're back to there is merely an accounting method change, right? We have a change or not accounting method change. I said there's merely a permanent error. They should have made the election on the returns in question and claimed the deduction on those returns. They failed to do so. Sorry, you were too late now. Statutes have closed. You can't get it, right? You can't make that work. Also, that they said, even regarding Revenue Procedure 2011-14, they're directory, not mandatory. And the Second Circuit took the position they cannot override the provisions of the Internal Revenue Code. So, in essence, since they're mere guidance without the force of law, that did not entitle Cannon to report the deductions as an accounting method claim, saying, sorry, guys, that doesn't work. Probably a little mean there, but we got it. Now let's go to the other two arguments then. Okay, maybe it's not an accounting method change. We know that, so you can't get it that way. But didn't the fact the IRS misled us? No, remember, we finally got this 2012 notice out just as we were finishing the 2011 return, and after the statute had been closed, most likely, on fixing the 2007, or at least there wasn't going to be time. So it was very, very late in the game. Well, the court said in this case on equitable estoppel, right? Equitable estoppel only applies when the government made a misrepresentation. There was reasonable reliance on that representation and affirmative misconduct, right? The court found that the IRS did not make any misrepresentations in Revenue Procedure 2011-14. The problem was the taxpayer was reading it more broadly than necessarily it was justified to be read, right? They didn't really say for sure this worked for designers. The taxpayer just assumed that from reading, meaning it's very, very important to very carefully read and make sure you're not making assumptions when you're reading like from something like that. And also, to be just totally honest, That's also something we see run into quite often when people, do things like, read a article or a summary, right? Those things, they're great, but they're summaries, they're articles. Make sure you always go back to your original source and tie that down. And we don't know how they misinterpreted this, at least per the court's view, they misinterpreted it. Did they actually work from this particular revenue procedure, or did they work from some sort of write-up of the revenue procedure? But really, when it matters, you should always go back and check the actual procedure. The article may be nice in understanding. Something like this podcast may be nice. A CPE course on an update may be nice to help understand. But remember, none of those are the actual law or the actual thing that could be binding on the service. Finally, they looked at equitable recoupment, right? And in this case, they borrowed the reference back to United States versus Dahm and said, essentially, this is a single transaction tax under two inconsistent theories is how you can get that, right? And in this case, the government has not taxed a single transaction or taxable event under two inconsistent theories, right? It says, the court said Revenue Procedure 2011-14 did not direct designers to report 179D deductions in prior years as accounting method change. There was no inconsistent treatment by the IRS. So because of that, you can't get out of this on equitable recoupment. So bottom line, the court found that the tax court was correct. They affirmed the tax court's judgment. They denied Cannon's appeal. It is improper to report Section 179D deductions as a designer as a 481A adjustment via an accounting method change. If a designer has not picked up the deduction for a year, or a couple of years that they could have picked up, they have to go back and amend that return while the statute's still open, right? Revenue procedures are guidelines. The court mentions that again. They do not override the IRC. That's a bit stronger than I think a lot of courts would state it. There generally is reasonable reliance on, if the IRS takes a position, and let's say it had clearly said designers could do this, I'm not sure that most circuits would agree that the IRS, could then go back on that. But they probably would. They could have used one of the equitable relief provisions in that case. But in any event, probably can't go back on it. That's kind of interesting because, there are a lot of times, there's sometimes we have real concerns about whether a revenue procedure actually is in line with the code, but it's more generous than the code. Like the one we all rely upon for pass-through entity tax deductions. There's a lot of questions about how that works, and whether or not that is the proper interpretation of the law, but we all like it. So, we follow it. If you took literally the way this court, is hammering on, you can't rely on a revenue procedure, in theory, it might seem that's wrong. And I don't see a court going in and, supporting that position. Okay. But like we said, you got to really be careful about deductions, timing, and, make sure you've really got an accounting method change. But more importantly, if you're not going to go for the 3115, you decide you're going to amend the earlier returns, make sure you don't have an accounting method change. You have to figure out which one you have. When you're trying to get a deduction that was, maybe available for an earlier year, is it because you had an accounting method involved that was in error? Maybe its accounting method even isn't allowed in the code. Or is it because just simply it was an error on the return? And by the way, what we mean there is an error without an accounting method implication. Aside from, and the IRS clarifies this normally, if it's the first year you've done the method, you've never had to do anything before with this type of transaction. If it's the first year, you can amend. Once you do it like 2 years in a row, that turns it into a method, and then you need the method clearance. Okay, next up, we're going to have the IRS providing some relief to those who file 1095Bs and Cs. This is Notice 2025-15, and what this relates to is a revenue procedure for allowing individuals that have to do those sorts of filings, and it was issued on February 21st. It allows people who issue those sorts of documents to be able to post it on a website if certain conditions are met. Okay. This is alternative methods for furnishing health insurance coverage statements under 6055C3 and 6056C3. Under the C1s of both of those, that's the one that you get to annual statement. And we've all seen the paper statements, right? Clients have been sending them in for a while. They get a B or a C. This doesn't affect the A's. The A's and the health and the exchanges are all totally different. And yeah, so we're not going to worry about the A's, right? This is the B's and the C's. The B's are generally the ones where you have an employer provided coverage or a non-exchange provided coverage, by a third party, but it's not an Apple large employer provided coverage. That goes on the B's. And then the C's are the ones that we have an Apple large employer who's providing the coverage. And this document, essentially for the ALE is really where it matters for the most part anymore, unless you're in a state that does impose penalties for not having adequate coverage, like California, for instance, does. Generally, the C's matter because those are the ones where you find out was there an offer of minimum essential coverage that, that essentially was affordable, and that allows people to get the credits. Okay. So what these sections, and they're effective for calendar years after 2023. So this is for filing these B's and C's, these information returns and how they can be filed, right? 6055 applies to, as I said, it says 1095B. It is any entity providing minimum essential coverage must furnish annual information returns. Again, this is what got you out of, basically the shared responsibility payment when that wasn't set at zero. So it got us out of those. Those were ones. Those statements still must be furnished to responsible individuals by January 31st. That's an automatic 30-day extension. That's why they can release this notice now. It's a little late in the game, but they did release this guidance, right? Late in the game. Under the law, the paperwork reduction law, they are allowed to post a 1095B on their website, a clear notice on the website, and they allow the individuals to request paper statements in lieu. So there is a method. It is found in a reg. We'll show you basically the reference to the reg here that basically contains the information about what you have to do. Under 6056, which is for the Apple large employers, this is the 1095C, right? And this is related to the health insurance offerings. In addition to saying it's a provision of minimum essential coverage, they also have to say if they offered it to you at an affordable price, if you're an employee, based upon the various rules involved. All full-time employees by January 31st has to have this with, again, a 30-day stay. And similarly, the law allowed, just like for Section 6055 and the 1095Bs, the ALEs can now post a notice on the website, again, allowing employees to request paper to be sent. And the papers have to be sent within 30 days. That's basically the structure. Now, the key highlights of the guidance. If you comply with Treasury Regulation 1.6055-1G4 little I, capital B, 1, 2, and 3, that's considered adequate. If you want to use the website reporting, this notice will not give you these details. Rather, go to that reg. B1 provides what needs to be in your notice and how it has to show, and the wording has to be there, right, on the notice. B says, essentially, you have to post it on the website by the due date for the notice to be provided. It must stay there through October 15th. That's so the entire 1040 filing season, it's up, so it gives them time to get it. And it does furnish the statement to anybody that requests a paper statement within 30 days of the date the request is received, right? That's going to be the way, that's what handles it. So again, if you request paper, you got a 30-day deal. Now, as I said, you really want to go look at that reg, especially 1, to figure out exactly what has to be on your website. Obviously, at this late date, my guess is a lot of people, because this guidance came out late, probably are just going to do paper this year. And then next year may consider the website option. We'll have to see how it goes. But if you really wanted the full guidance to make sure you were in line with the IRS, yeah, it didn't come out until the middle of February, kind of late in the game. It is effective for statements required for calendar years after 2023. Essentially, you want to make sure that everybody's aware of these alternative methods if you have clients that issue these statements. Probably most likely for those listening to this, maybe you are in a large insurance company and you're issuing, the 1095Bs, fine. But I think there are going to be more of you out there that may work with ALEs. And you just need to realize that this applies to you as well, but make sure you understand that regulation if you want to go down this path. Okay, next. The next case we have is going to be a taxpayer who is trying to get out of late filing penalties for a trust. This is the case of Dolores J. Murphy, who's a trustee in this case, and a whole group of others, versus United States. This is for the United States District Court for the Eastern District of California. It is case number 1:24-CV00260. And this opinion was posted by the court on February 19th. Now, this case involves Doris J. Murphy as trustee of the Charles M. Murphy, right, Administrative Trust. Right? This is basically her background. Now, she sought a refund of penalties for late filing of 2016 and 2017 tax returns. There were penalties also assessed in 2021 related to the payment of the 2016 and 2017 penalties, various things. What she's looking for is reasonable cause for late filing based on her reliance on her longtime CPA, who failed to notify her or prepare a trust return. And the question becomes, did she rely on the advice of a professional for something that she should not have known, she had no reason to know, or is she just trying to get out of, saying, the CPA should have done it, and, it didn't get done, and that's the problem. I relied on the CPA to file the return. And this is a subtle distinction, and it's going to address, basically, we're going to have to discuss the Boyle case from the Supreme Court, which does say very clearly that you cannot state as a reasonable cause for late filing a return that you relied upon, let's say, the CPA to get the return filed, get the electronic filing in, or that you relied upon the CPA to, let's say, file for an extension, and the CPA didn't, right? Those sorts of things. Supreme Court said there, the actual filing date is, everybody knows that's not beyond the ability of someone to figure out what the 1040 filing date is. And, you taxpayer have personal responsibility to make sure an extension's filed. You can't assign that to an agent. The question is this like that? Did Dolores Murphy as trustee, is she just trying to push this off on the CPA because, she should have known that this was due and should have known a return was required and, never questioned why the CPA didn't hand her a return? Or did she in fact rely on the CPA to advise her about whether or not a return was required? Which is a different issue. Okay. Now, this CPA, in this case CPA is Mr. Chaltraw, he provided tax advice to the Murphys and Murphy Bank, the company they were, involved with for years, right? After Mr. Murphy died, Mr. Chaltraw continued in his role for Mrs. Murphy and the administrative trust. The administrative trust is going to be our issue here. Remember, we have a revocable trust. Mr. Chaltraw dies. After Mr. Chaltraw dies, the trust became basically it went to the administrative trust form and was going to eventually divide into the multiple trusts that we often see, right, for that purpose, for estate planning. But Mr. Chaltraw didn't actually question whether or not there should have been another return. He had access to all data, but he apparently didn't read the trust or understand the trust or whatever happened. He never prepared a return. In this case, the trustee, Ms. Murphy, the widow, she simply relied on him to prepare accurate returns. And she gave him everything related to it. He failed to prepare a return for 2016 and 2017. In July of 2020, it was finally noticed that, hey, wait. You know what? There should have been, in essence, a return filed, right? All of these issues, right? All of these problems, because this was when her tax counsel, who probably wrote the trust, suddenly discovered no returns have been filed for administrative trust for 16 or 17. This is in February of 2019. And by the way, this is not an unusual story. Many cases, attorneys presume that the CPA will have access to the trust document and presume the CPA will properly interpret the trust document. That's not something that's unusual. I've caught over the years where various things have happened, like basically grantor trusts have not been recognized as grantor trusts by the tax preparer because they, even though they had the return, they didn't read the trust, or even if they had the trust, they never asked for the trust. By the way, little side effect in Arizona now, there is a special, they changed the law. So you just have a certificate of trust handed like to the banks, everybody. You're going to go set a bank account. So trustees are told you don't need to give anybody the full trust document. As I tell my clients, you got to give it to me because I can't rely upon that. That certificate doesn't tell me anything about any of these requirements. I've got to work with the actual trust documents because that's what the IRS is going to work with. And yes, while you don't have to provide that document to Chase, who is operating just to open a bank account for the trust, you do have to provide it to the trustee who needs to work from it. By the way, if Chase is going to be your trustee, they will need that document. And you need to provide it to the person who's working with you and doing any of the tax work because they need the trust document, right? I've got every trustee has come in because the attorney said you only need to give them this certificate of trust. Attorneys, please stop saying that. I understand why you do, but make sure you make it clear that their accountant, right, who's preparing the trust returns, so they're going to rely upon preparing the trust returns, or prepare the returns yourself, attorneys. I'm sorry, you got your choice. You can take on all the return preparation, and then, you don't have to show that trust to any CPA or anybody else, but I'm not preparing the return without the trust document. Bottom line. So just saying, kind of what we've got it, because I will tell you that I've had trustees walk in and it's been like clockwork since those notices came out every time. Oh, no, here's all you need. It's like, that's not all I need, right? I need the trust document. I have to understand the terms of the trust in detail. I'm covered by confidentiality rules. I can't disclose this to anybody, right? I can't go tell anyone, but I have to know what's in that document. It'd be kind of like going to a new attorney for your trust and just handing him that, certificate. Him or her certificate. It's like, that's not going to do any good either. Doesn't do the trustee really any good. If that's all you hand the trustee is that document. We're going to burn the trust. I don't know whatever we're going to do with that, right? So in any event, she relied upon it, and the late returns were filed in July 2020. They requested a waiver of penalties. Obviously, not all penalties were waived. Otherwise, we actually wouldn't be here if everything had been waived. Now, she argued the late filing was due to reasonable cause. She claimed she relied on her CPA, who provided her with erroneous advice, right? And she asserted that she provided the CPA with all necessary information and relied on him to prepare complete and accurate returns. Okay. Now, see, as I say, the issue is here. Did Ms. Murphy, should Ms. Murphy have known a trust return was due? In which case, if she did, the due dates and all that other stuff are known. She should have asked Mr., her CPA, where's my extension, right? Where's the return, right? Or is this something she really shouldn't have known? And was she needing the CPA just to advise her on whether any trust return needed to be filed? Because whether is a legal issue and goes way beyond what we would expect, a non-attorney, non-CPA, non-EA to understand, whether or not those are required. Unless you were a trust officer at a bank. If you are, you're probably going to be held to a higher standard there. But, Ms. Murphy was not that. So, is it legit here? The IRS, of course, argued that, oh, no. This is just like Boyle, right? She relied on a third party to file the returns for her. And guess what? That you can't do that. Per Boyle, she had a responsibility to follow up and check to make sure these 1041s were filed. The court took a look at Internal Revenue Code section 6651A1-2 regarding what's reasonable cause for late filing. Now, the court did agree the taxpayer bears the burden of proving the failure to file was not due to willful neglect and was due to reasonable cause. She has the burden of proof. And what we're asking for here is not for the court to find that she has reasonable cause, but to find that she has made, because this is the IRS motion to dismiss. and saying, has she in fact made enough of a showing that we need to go to trial and look at the facts? Or is it bottom line, even assuming all of her facts are correct that she tells us, that no, Boyle applies, tough luck, tough luck here, Ms. Murphy, you're just out of luck, right? You didn't do it. The court distinguished this case from Boyle. The catch was, in this case, the trustee did not know and had no reason to know there was now an obligation to file a return. The trust was the same trust in her mind, and really it was the same trust that existed before her husband died. It was the same trust, same document, nothing new. They had never filed a tax return for that previous one because it was a grantor trust, right? Now, the grantor trust rules of filing wasn't required. The court said she had no reason, Ms. Murphy had no reason to know that, that this was going to be something that now needed to file. It was not there. That it's reasonably possible that she'll be able to show she didn't know, she had no reason to know that this was a due date. And therefore, so if she can show she provided the CPA with all necessary information, and she can make the showing, that she relied on that information, then she could get out of the penalty. So the court said she sufficiently alleged that she reasonably relied on her accountant's judgment to allow this to go to court. They're not saying that they're going to hold that she actually, gets out of the penalty. They're simply saying that she has the right to present that evidence in the facts case, evidence to back up, what she put in her, in her filing, her arguments. She can present those facts. You don't present those facts at this point in time. These are simply her statements of what she can prove. And, so now she goes to court, she proves it. The IRS will, put up whatever counter evidence and the court would make a decision, but it's too early to kick it out of the court, right? She found too, and the IRS also tried to say that she didn't file her claim for refund on time. She made a January 7th letter to the government that did request penalties be, waived on this return. And number two, the IRS actually waived 1 year based on that. So it's like, you guys acted like it was a claim for refund on this year. Why aren't you going to count it for the others? Court said, no, we're not going to let that. So essentially, except for the year that they, that they found that they had already paid back the penalties, the court dismissed, said, yeah, the IRS's motion to dismiss is allowed for that year because really nothing left to deal with in that year. But the other years where the IRS still has not waived the penalties, we need to go to trial, right? IRS has to prove this, that it's there. This is what makes it really important there be clear communication, documentation between advisors and their clients, right? To rely on a tax professional, the taxpayer needs to show that they provided all necessary information and reasonably relied on a professional that they had no reason to doubt, their capability to deal with this, right? That's the key. This is where, it can be really, really important. We get into things like, about engagement letters, the data the client provided to the CPA, the questions they answered. Did Ms. Murphy provide the trust of the CPA? Did the CPA have the trust? What exactly did Ms. Murphy, do in this regard? What did she provide? She still got to show what she provided. She still got to carry that burden. But they're not going to get an automatic dismissal under the theory that, this is just relying on a third party. And as I noted, the distinction is subtle, but important. Because this is similar to a case years ago where an estate got out of a late filing penalty for the estate tax return because they had provided full information to counsel regarding the assets of the estate, and counsel had failed to advise them that a 706 was necessary, right? Needed to be filed. That was reasonable cause. They had no reason to know, about the specific rules, especially as exemptions and things have changed over the years. Things have gotten crazy with the credits. They had no reason to know about that. That's advising on whether return is due with a taxpayer who doesn't have the background to be able to make that judgment independently. This would be the same argument here. Okay, finally, we're back to the beneficial ownership information reports. It's been an interesting few weeks. We've talked about it. We told you about the fact we had the current administration filing again with the courts. And it doesn't look like there's a major change in direction on how this administration is going to be litigating this issue versus how the old one did, aside from some discussion now, which I kind of wouldn't have been surprised had the prior administration done the same thing at this point, that there might be some future relief, but we need to get this thing in now. So we're going to have court actions to talk about here. Basically, a court action in the Smith case. We'll talk about congressional action and FinCEN guidance, all of which happened this past week. So, essentially, first thing we're going to look at here is what happened in court. This is a ruling in the case of Smith versus United States Treasury. As you may recall, that case was the lone case preventing FinCEN from enforcing the Corporate Transparency Act. There was still an injunction against enforcement that was issued after Texas Top Cop Shop came out, and after the and after basically the Fifth Circuit had reinstated the rule, and then Department of Justice went to the Supreme Court to get a ruling. But before the Supreme Court ruled, that had put out a nationwide injunction against enforcement. Justice Canuto, who issued this injunction, took under advisement a filing from the Department of Justice saying, hey, go read Texas Top Cop Shop ruling from the Supreme Court. Go see that little note. We think you probably should stay this order at this point, right? In this case, the judge did stay his order. So that order in the Smith case was pulled. The order no longer applies, right? So basically what ends up happening is we ended up with the order applied with the Smith case coming in place on the 18th of February. So suddenly there's nothing blocking enforcement of the Corporate Transparency Act against most U.S. taxpayers, aside from those involved in the Alabama case, where they'd issued an injunction that only applied to the plaintiffs and the members of that one organization. So that's the only injunction left standing. FinCEN had made a note in there, as we talked about last week, in their motion, the Treasury did, or the government did, saying, hey, if you grant this, we will set the deadline 30 days out, at least 30 days out from when this takes effect, when the stay goes away. And we will consider making some other changes. So that's where we stood at that point. Now, after, in the midst of all that, at the same time, we had happening, essentially a little bit earlier in the week, we had the House doing some stuff. Now, you may remember that the House that we had in the continuing resolution, that was one that had a bunch of things on it initially, the ones that got torpedoed when, the now president, then president-elect, voiced his opposition to it along with Elon Musk. And we got a very pared down continuing resolution that just had the CR on it and didn't have these other things. Well, we're now going to revisit what was in there that would have pushed back the required filing date for the BOI reports only for entities that were in existence on January 1st, 2024. Keep that in mind. It is very, very limited. It would have pushed their required filing for their first report from January 1st of 25 to January 1st of 26. That got taken out of the package. So the last Congress did not pass that. We now have this back reintroduced into the House. That's House Resolution 736 to protect small businesses from excessive paperwork Act of 2025. It did pass the House unanimously among those who were present and voting, which was a vast majority of House members. And it passed it on February the 11th or February the 10th. However, it then got recorded in the Senate, assigned to the Banking Committee, and Banking and Financial Committee, whatever, forget the full name of that committee at this point, got assigned to them on February the 21st or February the 11th. And we're now sitting here on the I'm sitting on the 23rd, Sunday 23rd, recording this. And yeah, they haven't done anything yet. If it was enacted, it would basically push back the filings for a year of those entities that were in existence on January 1st of 24. However, even if enacted, it would not impact an entity that's formed in 24 or that you form in 25. Those would still have to meet their 24 90-day deadline, 25 30-day deadline for filing the reports. It would not extend everybody. The law is very short. The bill is very short, very clear. I had somebody ask if that was an oversight. I'd say, well, if it was, nobody was paying much attention. It's very clear the way the bill is worded, it only affects those returns. And I don't think that's an oversight. I think their concern is that people who've already filed 24, who did, let's say, formed an entity in, say, February, March of 24, went ahead and filed, would now be all upset if everybody else who didn't file, got a free ride. That's difficult for Congress to do. They don't like that. They don't like being accused of giving deals like that. So I don't think it's an oversight. But keep that in mind. It doesn't solve the problem entirely. Secondly, it's still a really big if enacted. And third, even if enacted, will it be far enough in front of the deadline we're going to talk about here in a second to make it worth waiting? Is, how long can you afford to wait without doing something if you're facing, especially a bunch of clients who have not filed and they all want you to help them fill out the filings? Because I don't understand these computers, because it has to be electronically filed. So keep that in mind. We got a problem with this bill. It needs to start moving fast, like now. So any senators listening, it's got to move now. It's got to move now or it's irrelevant. That's the way I'd phrase it. So FinCEN did post updated guidance that you're going to find both at their website, https://www.fincen.gov/BOI, and a formal notice, FIN 2025-CTA1. Both of them tell you that we now basically have BOI reporting requirements that are back in effect of following the stay in Smith. They said, hey guys, now we're enforcing again. So we're going to start enforcing, and we're going to do it under this is our conditions. We realize everybody can't file the day after Smith injunction went away. So we're going to put in a new deadline for most reporting companies. Now, by that, I mean companies that were in place, that were in existence on March 1st of 2020, or I should say on January 1st of 2024, so they existed before that date. Their filing deadline for initial reports will move to March 21st of 2025. That's also true if you have an updated or corrected report that, let's say you were required to file during this time period from December 7th, effectively, of 2023 through February 18th of 2024, I should say, was the first one, and through February 18th of 2025. Any of those reports, let's say that somebody moved during that period, right? Or you found that, we filed we filed our initial report, in, let's say, early December of 2024, but then we discovered there was an error on it. So we were within the 30-day, 90-day rule to file the correction. If that 30-day, 90-day period expired during, while everything was on hold, you'll have till March 21st, 2025 to file. So that'll be your key. Again, will not help any entity formed in 24 or 25 unless they had an updated or corrected report that would have been due during the stay period. Okay. If a company had a previous deadline later than March 21st, 2025, they would follow that the later deadline they already had. That would be for those who were given disaster relief. They, I believe, have an April deadline. It will still be the April deadline. That doesn't change by this. And they also remind everybody that if you're one of the plaintiffs in the National Small Business United versus Yellen case from Alabama, right? You're in that group. Basically, those people, those specific plaintiffs and members of the organization are still exempted from filing because that injunction was not a blanket nationwide injunction. That was an injunction only for the plaintiffs in the case. Okay, so that one still applies. If you're covered by that Alabama one from March of 2024, yeah, that one still applies. We're still waiting on the 11th Circuit to issue their opinion. Now, realize if you're covered by that, keep your eye on that 11th Circuit opinion, because if the 11th Circuit were to throw it out, were to basically throw out that injunction, yeah, those people could have a quick having to file as well. So keep a watch on that. That case was argued back in September before the 11th Circuit, and we're still waiting on the decision. And it's been in consideration for a long time. I'm not sure if the 11th Circuit is just figuring that all of this will wash out on its own, so we're just going to ignore that we have this, or if they're going to be releasing it anytime soon. But yeah, we have that particular problem with it. Okay. So basically, March 21st, mark that right now. And let's stop on this this instant. Basically, March 21st. For right now, that is your date. The next slide has discussions of what FinCEN might do, but they haven't done any of it yet and really haven't committed to doing anything before March 21st. So don't rely on this potential delay, just like don't rely on Congress getting around to it until they do it. Once they do it, yeah, then we can work with it. But until they do something, and as I said, and with the bill, it's not just passing the Senate, it's also going to need to be signed by the president. So make sure we've checked all the boxes, right? House passed it, Senate passed it, president signed it. Because none of that will count until all those happen. But FinCEN did say that they intend to revise the BOI reporting rules this year to reduce the burden for certain lower risk entities, right? And they also indicated that they might change the due dates prior to the March 21st date for some entities, but there's no, everything go read the notice. We have that linked in our materials this week. Go read the FinCEN notice. They never commit to anything. So at this point, you just have to assume your client needs to file and make sure your client does the filing, right? Get them to file, get it done. I'm pointing out to people that March 21st is just after the drop dead pass-through dates and right when we're really ramping up quickly to try to get returns, individual returns filed by April 15th. That is not the time to have to shut down for a week and process BOI requests for the clients that, that wanted to delay but didn't want to take the responsibility of having to file the form. Like this point in time, either, I tell any client right now, if you're still willing to do it, to get the stuff in now, like tomorrow, or if you say, no, I don't want to do it, they might not require it. It's like, if you're going to go down that path, maybe something will change by March 21st. It's like, that's fine, but it's now your total responsibility to get it filed. I cannot help you on March 20th. When you decide on March 20th that nobody's coming to save you, sorry, you're on your own, right? In essence, put some hard deadlines in place. Because if you've got clients that don't want to file, and that's a valid position, that's a fine position, but I can't bail you out if it turns out, that you're wrong. And nothing happens by March 21st, because the Supreme Court took away your protection. And my feeling in looking at that order was there's no reason for the Supreme Court to have removed that order. Because even as Justice Jackson said in her dissent, look, what's the emergency? They've delayed this for 4 years. Why can't we just let the regular appeals process go? I think they didn't let it go because the Supreme Court wants to telegraph, gang, this is valid. We're not putting up with these orders stating it's not. We're going to find it's valid. So just kind of get it together. That certainly seems to be what the Eastern District Court in Texas on the Smith case decided. Yep, it's been telegraphed that they're going to find this thing valid. So yeah, just quit bugging us, quit doing it. Now, where do we stand? Okay, let's talk about where we technically stand on all the cases. Currently, obviously, we got this from FinCEN and potential. Other potential things in play. Again, none of which may actually have anything happen to them by March 21st. In fact, I think most won't. We have the 11th Circuit appeal in the National Small Business United case, right? that could come down. If you're relying on that case, that is one you're going to watch, because you don't have to file by March 21st unless that relief goes away. So if you are relying on that, you're a member of the organization, or you're one of the plaintiffs, which is less likely, but you're a member of the organization, keep your eye very closely on the 11th Circuit. Because, if they come down, and again, the theory being they might, even if they weren't leaning toward getting rid of this, basically of getting rid of this injunction, they might now say, well, Supreme Court obviously is going to make this thing valid, so why in the world do we just want to get reversed? So, I think the odds are if the 11th Circuit comes out now, it's much higher chance they're coming out and saying, yep, Congress has a right to do this. We're done. Because the Supreme Court seems to have telegraphed that pretty loudly currently. So we have that one. We also have the Fifth Circuit looking at, the Texas Top Cop Shop case. Now, if they rule that injunction's valid, that doesn't put it back in place. The Supreme Court has stayed the injunction until, at the very least, the Supreme Court, they'll wait to see if cert is requested by the government if the Fifth Circuit were to restore that. If cert is requested, the order would not go back into effect until the later of the day the Supreme Court denies cert in the case, says they won't hear it, or the date the Supreme Court actually issues a decision in the case and says that order's fine. So that one's not going to be a rapid fix, whatever happens there. So that won't be by March 21st, regardless. Basic government still have time to file requests for cert. Their deadline for that's well past the 21st of March. So that's not going to work. We also have then cases, two cases, one from the Fourth Circuit and one from the Ninth, cases we discussed last year, where the courts denied the injunctions. Those are currently, things are being filed in those cases with the courts of appeal, but I don't see those cases getting decided by that date. Again, most likely my own outcome is going to be either all the courts of appeal start issuing they have authority to do this, taking their cue from the Supreme Court, so the Supreme Court doesn't have to say anything about it, or the Supreme Court picks up Texas Top Cop Shop, assuming that the Fifth Circuit were to say, yep, the injunction is good again, and they would apply it from there. So, like I said, keep your eyes on this, but it's happening. Don't forget March 21st right now. Yes, things might change. Yes, it might be you might get another pass on that. But we're getting way too close to that date to not pay attention to what it's going to mean, if we start getting to March 7th, 8th, 9th, 14th, and we still don't have relief. Yeah, how's that going to affect your practice if clients are relying upon you to get these reports filed? How would that affect your other clients? So that's going to be the key. So this has been the Current Federal Tax Developments for February 24th, 2025. As always, Current Federal Tax Developments are brought to you by your state side of CPAs. I'm Ed Zollers, and my email address is there on the screen, edzollers@currentfederaltaxdevelopments.com. You're watching the slide version. You can send things at currentfederaltaxdevelopments.com or my regular firm email address, edzollers@thomasollerslynch.com. You can send there. You also can get a hold of me if you wish. You can if you're a member of the state societies in Arizona, New Jersey, Minnesota, Idaho, Illinois, Washington. I do take a look there. Minnesota, I thought I put in the list too. Hopefully I remember them. I do follow their Connect sites. I do take a look at their stuff. So if something goes up, I may very well respond if I think I could be helped there. So you can put something in that regard. Otherwise, we'll see you guys back next week for more things happening in the area of current federal tax developments.